I'm Steve Sanders with First Financial Services, and we're starting a series of segments here that we call Opening Doors. And the objective is to give you some insight into the factors that affect the markets and that impact the decisions we make on a day to day basis on the investment side. So, this initial one is going to talk about really the most dominant factor of the last couple of years in markets, and that's the rise in inflation and the response from the Federal Reserve to dramatically increase interest rates. So the rise in the consumer price index, and that's the one that we're going to use. There are many measures of inflation. Kind of goes back to economics 101. When demand is strong and supply is limited, prices go up. And so we'll take you through a few slides that kind of illustrate what happened over the course of 2020 and 2021, and then talk about how the Federal Reserve responded with rapid interest rate increases. So this first slide shows the unemployment rate in the US. And you can see when the pandemic hit in early 2020, it immediately spiked up to almost 15%. But what's really notable about this is by the spring of 2021, the inflation rate was already down to 6%. And within about 6 or 7 months after that, it was back to 4%. So the recession was over and most people were employed. That speaks to the demand side of the US economy. This is a chart that's busy, but a lot of the economic data that we get as analysts is dated, meaning we get it a few weeks or a few months after it actually happened. This is a chart that highlights what's called high frequency economic data. And there are 6 lines on here. The ones on the bottom, you can see took an immediate steep drop, and in most cases took until well into 2021 to recover. So those are seated diners, airport traffic, hotel occupancy, navigation usage. And during the pandemic and the social distancing, we tended to stay at home. And so those services oriented things, there was very little activity. But more notable are the 2 lines on the top. One of them is consumer debit and credit card transactions. And you can see that took a quick dip as well, but it pretty much recovered by about the same time that unemployment rate reached 6%, which was in the spring of 2021. And you'll see mortgage applications in the same kind of trend. There was a quick drop, but then within a few months, mortgage applications were above where they'd been prior to the pandemic. So what this tells you is consumers were spending and they were doing things that stimulated the economy. They just were not doing the more services oriented things that were tied to social distancing. As we all know, there was a massive and rapid response by the US government to provide stimulus across the economy. And several of these programs came out in the spring, and then there was another one that went all the way into March. So, kind of tying those 2 slides together, we had a consumer by the spring of 2021 that was in pretty good shape with unemployment fairly low on a historical basis. At the same time, we had 5+ trillion of stimulus coming into the pockets of consumers. You put those 2 together, you get very strong consumer demand. Then when you marry that with supply disruptions associated with COVID, producing goods, transporting goods, what you see is prices go up. So during this time, consumer behavior switched significantly. So again, instead of going on trips and staying in hotels, people were buying stuff. Boat sales, RV sales, fixing up their houses. The Home Depots of the world saw huge surges in demand. So the consumer was spending, they were just spending on different things. And the things they were spending on were the most affected by the COVID production disruptions. This is a chart that shows the consumer price index from early 20 until basically about a month ago. And so what you saw, similar to some of the other charts, is you saw a quick drop in inflation during the initial stages of the pandemic, but at about the same time the employment rate had recovered to 6%, consumers were feeling fairly confident again, and that's exactly the point when inflation started to spike. And so we saw inflation spike all the way up to 9% in June of 2022. And just before that, the Federal Reserve started rapidly increasing interest rates to cool the economy. And the way that works is fairly simplistic. All interest rates kind of move together. They're driven by the Fed. And so interest rates for businesses on debt, for consumers on credit cards, begin to spike rapidly. And the intention is to slow the economy, and by slowing the economy, to cool the inflation. These are the Federal Reserve rate increases that we saw over the course of 22 and going into 2023. This is one of the steepest periods of rate increase that we've ever seen from the Fed, to go up over 4 percentage points over the course of just 2022. And we are certainly seeing the impact on the economy from that. So the basic point here is that COVID disrupted the entire economy for a very short time, but because unemployment recovered quickly, consumers gained confidence that they were going to keep their jobs, consumer demand rebounded pretty quickly as well. It just shifted towards goods and away from services. But the supply chain was disrupted, so the prices of those goods started to go up significantly. The Fed comes in with aggressive rate increases. And then as the pandemic waned in 2022, we saw consumer demand shift from goods back to the services. And so the composition of inflation has shifted along with that. And so now our primary inflation issue is on the services side of the economy. So inflation has come down substantially, as you all know. It's come down from that peak of 9% down to about 3 to 3.5% over the past several months, but it's still about a point away from where the Fed would like it to be. So we expect it to continue to come down, but the timing of that is always a little bit difficult to predict with certainty. So in the next segment, we're going to talk specifically about how that rapid increase in interest rates affected the price of bonds, which are investments that we use every day in the management of our portfolios. We'll follow that up with one about how interest rates directly impact the price of stocks. Thanks for listening, and we look forward to the next segment of Opening Door.